Well, good afternoon, everybody, and welcome to today's webinar on the subject of the new dividend tax. My name is Murray Cowell, and I'm hosting this webinar on behalf of award-winning DEB Chartered Accountants. And with me today is David Edwards-Brown from DEB Accountants. Hello, David. So David and his team mainly support owner-managed businesses, and he's one of the most qualified and experienced accountants in the country because, as well as being a qualified chartered accountant, David is also a chartered tax advisor, and he was one of the first 100 people in the country to become a chartered financial planner, which is the top qualification for independent advisors. So he's an expert in accounts, tax, and financial advice. So that's quite a combination. And DEB accountants have been finalists in 20 awards over the last 4 years, including being the only firm in Yorkshire to be finalists at the British Accountancy Awards for each of the last 3 years. And they also won an award for innovation in technology, which was awarded by the 2020 Innovation Group. They were runners-up no less than 5 times, so they were delighted when they finally got to win. And last year, they won an award for digital creativity in business at the Barnsley and Rotherham Business Awards. So you can see from all of this that David is no ordinary accountant. And the experience that he's gained over the last 40 years enables him to help business owners to understand how the tax system impacts on them and their business. And his objective has always been to assist business owners in minimising the amount of tax that they pay both now and in the future. So David will be presenting today's webinar, but just before we start, let me just say that if you have any questions as you watch the webinar, please let us know by using the Q&A box at the bottom of your screen. We won't be enabling anybody's microphone to ask questions because we're recording the webinar for people who have been unable to attend, and we want to make sure that we've got good quality audio throughout. So instead, please use the Q&A box, type your questions in as we go along, but we're going to save them until the end because we've got quite a lot to get through today, so we want to make sure that we stay on schedule. And then when we get to the end, the Q&A section at the end, I'll read your questions out so that David can respond to them. So, without further ado, let me hand you over to David. David, over to you.
For about 6 times now, and I must admit I've never been as nervous as I am at this moment in time, being at the vagaries of the software. So I'm hoping that it will work correctly. We have got very poor internet where we are at DEB House, and we've been worried all week how well the presentation will go. I've also noticed that the graphics on some of the slides which I'm doing, I'm just trying to move the slide and it isn't moving, Murray. Perhaps because I'm going the wrong way. The graphics tend to move a little bit slowly, so I do apologise for that as well. As Murray said, we're trying to do as much as we possibly can for all our clients, and part of the reason for doing this series of seminars, and in this case a webinar, is to try and raise the level of standing of all DEB clients and anybody else that wants to come along onto the seminars and webinars, so that they've got a better understanding of where the position is, so that they can take advantage of the situation, get the best out of the rules that exist at this moment in time, and know how to react when they come along to dealing with the dividends after the 5th of April. One of the seminars that we've been put on is part of what we call the DEB Business Wise Forum, and the idea is for us to present seminars and webinars on topics which we have got some experience in, but also to invite other professionals to come along and do presentations which will benefit the business community as a whole. Last Friday we did one on procurement where a specialist came in to advise clients how to get contracts from local government and national government, which are available to small businesses, which was quite surprising. And we're going to have a solicitor coming along to provide us with the pitfalls of employment. So we've got a number of these things set up. So it's not just going to be presentations from DEB, it's going to be presentations from other professionals who have got an objective of helping local businesses, as we believe that if we help local businesses, local business improves, we all benefit. Okay. So let's move on to the dividend tax. This is a new tax on business owners, and it's going to increase the tax burden that they have to bear each year. And it's not as if they aren't paying enough already. If business owners are already paying tax as they're earning their profits, and there's a series of taxes to local government and to national government, plus there's kind of things that are imposed upon them, like auto enrolment pensions, which are starting to bite in on clients now, which makes it so that the price that they are having to pay is ever increasing. But even once you've earned the profits, the inland revenue are there again. And most companies have got to suffer corporation tax at 20%. So you pay tax on whilst you're earning the profits, you pay tax on the profits that you earn. But now, with the new dividend tax, this is a tax on extracting those profits and trying to take them out for the benefit of the shareholders. Now, the whole objective of this seminar is to kind of give you an indication of how you can get profits out of your companies, and it's getting more and more difficult. Now, I like to make this sound like it's a game. There are rules to this game, and if you understand what these rules are, then there's a good chance that you're going to play the game well. Whereas if you don't understand what the rules are, it's like playing football and not knowing which way to kick the ball. You're going to make mistakes, you're going to play it wrong, and you're playing against the inland revenue, who is an excellent player of this game. I did say the graphics are a little bit sluggish, but of course is to play the game to win. Otherwise, you will lose, because the inland revenue will just take advantage of the situation and you'll end up paying more tax. Now, this is to contrast with what has been kind of the general thing which most business owners have done, advised by most accountants. They literally do their own thing. They take out whatever money that they want out of the company, and they leave it up to an accountant at the end to come up with a solution, to wave a magic wand and create fictitious salaries and dividends and say, okay, that's solved your issue and here's your tax bill for this year. But they don't take any participation in this process of how to play the game and how to do it correctly. And it's getting harder to do that. It's certainly not as easy as it was in the past to be able to do this. Apologise for this, the graphics are going very, very slowly. The first thing that kind of came to make this more difficult was RTI, real-time information. It's now not possible to say, oh, back 18 months ago, we had a salary of £8,000 or whatever figure you had, because the information has to be reported through a PAYE scheme on a real-time basis to the Inland Revenue. Also, there's been a series of cases through the courts where the Inland Revenue were attacking dividends. Was something that was actually done, which was put down in the records as being a dividend, was it a dividend or was it salary? And they've got some successes in challenging some of these issues. So doing retrospective dividends, pretending that these dividends were done several months ago, is not something that's a really clever thing to do, because they are coming under scrutiny by the Inland Revenue and they are being challenged through the courts with a degree of success. Now, HMRC are great players of the game, so you need to be clued up yourself in order to know how to combat the things that the Inland Revenue are ever increasing putting in your way. You've got to get it right. Now, to do this, what you've got to have is a strategy. You've got to manage your affairs and plan them and think ahead to kind of do things in the right way in the first instance to make sure that you're doing things correctly. Now, in order to do this, you've got to have advice, you've got to have information, you've got to have help, and you've got to have guidance. And this is, to a certain extent, what we've tried to do at DEB, to try and give an understanding of what the situation is, so that you can manoeuvre your way through and do things correctly, rather than doing them incorrectly, which then the revenue will take advantage of. The issue is, though, that everyone is different. It's not possible to have a formula and say, this is the way that you do things year in, year out, because everybody's different, everybody's got their own income profiles, and as a result of this, they have all got to be treated differently with a different strategy. Now, in terms of the strategy, we first look at what the situation is now, and up till the 5th of April, so we've only got a few weeks to do. We've been doing this seminar since November now, and we've had loads of our clients on the seminars, and the idea is to try and give them a plan of what to do between now and the 5th of April before the provisions come in. Now, for the existing tax year, everybody's got a personal allowance of 10,600. The basic rate band is 31,785. So you don't start paying higher rate tax until you get to £42,385. So the number one strategy is, first of all, is to take a monthly salary of £671, which is an annual equivalent of 8,060. Now, this taking a salary is a win-win-win situation. In the first instance, it's tax-free. Each individual's got a personal allowance. For next year, that's going to be £11,000, and 8,060 falls well within that, so they can take that money out of the company completely tax-free. Also clocks them in for national insurance. Now, national insurance contributions, when you get a credit, it counts for a number of benefits. The most significant one of which is the state pension. And if you didn't do a salary and put it through PAYE, then you would have to pay Class 3 contributions, and they cost £733 a year. So by putting a salary through, you get a credit for your national insurance contributions, which adds towards all these state benefits, but also clocks another year up for your state pension, and you need 35 years to make sure that you're entitled to a full state pension by the time you reach your retirement age. If anybody's uncertain about what their pension entitlements are, you can do it log online to try and check it out, or just download a form BR19. Fill that in, send it off, and they will come back to you and tell you how many years you are short of, in terms of contributions, and what you're likely to be by the time that you get to your retirement age. But you need to get the year's credits in, and paying a salary clocks you in. So you've got the tax relief personally, you don't pay tax on it, you get the national insurance credit, but you also get tax relief in the company. You get a corporation tax relief, and at present rate of 20%, that's worth £1,612. So it's inevitable that you are going to benefit by putting a salary through, and it's a no-brainer that you must do that because, as I say, you win 3 times over by doing that. The amount that you take out as a salary has been affected by the introduction of the employer's allowance, which is for the last couple of years has been £2,000, but next year it's going up to £3,000. However, they are going to exclude it for anybody that is a sole director. So it's so easy to get round that, you just create an extra employee. Find a spouse or a family member or someone else to pay it, and then you'll get the benefit of the £3,000. But if you can get the employer's allowance, then it does pay you to take more out in salary. And for the last year, we've been advising our clients to take out the full personal allowance, which was 10,600, will be 11,000 next year. in order to get the advantage of the employer's allowance. You still pay a small amount in national insurance contributions personally, but you get greater corporation tax relief than the amount that you're paying. These webinar notes or seminar notes were done well before the present budget, and I was speculating on all the seminars whether they would bring anti-avoidance measures in to counteract people just adding their spouse as an employee. I've not seen anything arise in that now, but I thought that that was a possibility. However, if you have only got few employees, in order to use up the employer's allowance, then a monthly salary of 883 is better, and that's equivalent to your personal allowance this year of 10,600. Obviously, that's going to go up to 11,000 when we move into next year. Now, this is the reason, the rationale of why it was better to do a higher monthly salary if you've only got a small number of employees. The national insurance that you pay is 305, but the corporation tax saving that you get is 508. So you're slightly better off by about £203. In order for something to be a salary, you can't just record it in your bookkeeping and say that is a salary. What you've got to do is open up a PAYE scheme and record it through real-time information. So there's a price to pay. You've got to do the PAYE scheme or pay someone to actually do it for you. You must have a PAYE scheme. It's advisable to have pay slips, and it's also advisable that you pay the precise amount that is on the pay slip and don't leave it unpaid. The idea behind that is that you are identifying that item, that payment, as being your net pay, which means that other items that are going through, perhaps dividends and loans, cannot be argued by the Inland Revenue as being part of your wages. So we're always very keen at DEB to advise clients to do a payslip and actually pay it, even directors. The number 2 strategy, once you've taken out basic rate salary, is to do dividends within your basic rate band. And if you are taking £671 out, then the dividends that you can take out this year is £30,892. If you're taking the bigger salary in order to take advantage of the employer's allowance, then obviously the dividends are a little bit less, just short of £29,000. Now, basically, every year we've built a strategy with all our clients and advised them that if they have got the capability of taking dividends out within the basic rate band, then they take it to the limit. And this is even more so this year, because it is the one and only opportunity you've got now to take money out without incurring the additional dividend tax, which is going to be introduced from the 6th of April. So whatever capability you've got of taking a basic rate dividend out for 2015-16, it pays you to take it out. And you need to discuss this with your accountant now. We've only got 2 weeks before we get to the end of the tax year. And so if you've got any capability of taking out dividends, you need to do it now. Now, dividends are very legal things, although with most accountants, you wouldn't believe it. They just pretend that a dividend was done once they get the books and records in, probably 18 months after the event. But this is so easy for the Inland Revenue to attack. So let's go through what the legalities are related to a dividend. Now, basically, the amount that you can pay out as a dividend is the current year profit that you've made, less 20% for the corporation tax that you are eventually going to have to pay on those profits. But you can add to that the prior year's retained profit. Now, the sum of those two items, current year profit less tax, plus the prior year retained profits, gives you a pool of money that is available for taking dividends out. If you haven't got that pool of money and you take something out as a dividend and call it a dividend, it isn't a dividend. it's illegal. It's not a dividend, and therefore it leaves the inner revenue free to speculate what it is that you've taken out. And there's lots of options whereby they can say you owe tax if they can redesignate that as something else. I did say earlier on that dividends are under attack. Now, obviously, in order to take it out, you've got to have something whereby you calculate what the profits are. You can't pay dividends out of fresh air. They have got to be paid out of profits. And the inner revenue will actually challenge a dividend if they think that you had no reason to think you had any profit at the time that you voted it. So you need to have something to record what your profits are, and that's usually some sort of accounting package. At the moment, we're developing Debug Proactive, which we're about 3 years into the development of this, which is a bookkeeping program, and the objective of it is to be able to do bookkeeping for our clients, because we're getting an increasing demand to do the bookkeeping for clients. Clients simply just don't want to do it, or haven't got the time to do it. But in it, we are building a tracking system to try and keep a record of what profits they've got, what dividends they've taken, and what salaries they've got, so that we can give better advice on strategy as their client goes through the year. And this is going to become more important when the new dividend tax comes into play. The next thing you need for dividends is you've got to have documentation. As you vote a dividend, the directors take a decision. Yes, we've got profits. Yes, we want to do a dividend, and therefore you do a minute of the meeting to vote the dividend, not to vote the dividend, okay, the dividend to the shareholders. You then need to do a dividend voucher to pay out, to give out to the shareholders as you pay the dividend to the shareholder. And the general rule we say to all our clients is documentation first, payment second. Not payment first and then your accountant put in a retrospective documentation in 12 months later to say, let's pretend the dividend was done properly. Clients of DEB are well aware that if you need documentation, you log onto your portal on DevConnect and you go into the files area, and there's a dividend request form which you can do. And you can upload that onto DevConnect, and the day later you get all the documentation. In fact, what's coming in next year is Fast Connect, where we'll be able to do this on your mobile phones. You'll be able to just request the dividends in seconds, just clicking a few buttons on your mobile. This is something that we've always suggested to clients as being essential, though in reality it's not. But it's always better if you do the documentation for a dividend that you pay it in full. Now, the reason for this is that the inner revenue can't argue that a dividend that has been paid today is a dividend of today and not a dividend of tomorrow, or more likely in the next tax year. Just imagine if you don't have documentation, you don't pay it this year, and your accountant comes up to you next year and says, oh, we'll pretend that was dividends. If the inner revenue can establish that that dividend came to light and was established in the meeting to discuss the accounts 6 months after the end of the 5th of April, then you will have tax to pay on it. So they've got every incentive to challenge when these dividends are done. Actually paying the dividend in accordance with documentation that you've provided it's definite proof that the dividend was done on a particular day. And you need that definite proof to kind of anchor that dividend in the tax year that you want it to. If you can't pay it, then at least record it in your bookkeeping. I mentioned that we were doing it on Debug Proactive. In order to do it, you've got to have something like Sage or QuickBooks or some sort of accounting program where it's not paid, you can credit the director's loan account and debit dividends. One other option is to amend the documentation to say that if the dividend isn't paid, within a short period of time after that, it's credited to director's loan account. And DB clients will already notice the change on the documentation that we're doing on both the director's minute and the dividend voucher. It actually says that if it isn't paid within, I think it's 10 days, it's deemed as credited to the director's loan account. And we have in fact had an instance where a client, where the Inland Revenue was challenging the dividends, whether they were actually paid and when they were actually paid. And rather than getting to that argument, we actually sent the dividend vouchers saying that it was credited to the director's loan account in this way, and they just accepted it. They didn't go any further with it. So we've had a little bit of a test that doing that on your documentation actually works. However, what you should do is actually pay it, so that there's no question that the dividend was done on a particular date. Again, you don't want it being established that it's when the accountant does a fix after the year end, that's when the dividend is, because you could find that that then drags it into next year, where you'll hit the dividend tax. So you've done your salary, you've done a dividend up to the extent of your basic rate band. Your next strategy should then be to withdraw any money that you've got on your director's loan account. Now, the thing to bear in mind here is that the director's loan account is not a financial black hole, out of which any amount that you want can be paid. You need to be aware of what your director's loan account is, because if you withdraw that director's loan account, you will have to pay Section 455 tax, which is an extra 25% tax which is payable to the Inland Revenue. A little bit later on in the notes, I've actually said that it possibly would have been an idea to pay Section 455 tax because it's cheaper than paying the dividend tax. But in this year's budget, which is just was last week, they actually have changed it, Section 455 tax, to align it. So instead of paying 25%, you'll be paying 32.5% any amount that you overdraw a director's loan account, and don't repay it within 9 months of your accounting date. So you can only withdraw from your director's loan account the amount that you've got in there. So again, it's a question of being aware how much you've got in your director's loan account. You should at least know what it was at the end of the last accounts and add and deduct amounts paid in and taken out since that date. Again, in Debug Proactive, we're actually building in the strategy section a kind of an indication to clients of where they stand with the director's loan account, so they know if the company does owe them some money, that they can take some money out. But what you mustn't do is overdraw. So you've got your salary, you've got your dividend, you've got your director's loan account, providing the sum there, but once your director's loan account runs out, the next strategy is out for a higher rate dividend. You're paying dividends out over and above your basic rate band. Now, basic rate dividends, at this moment in time, you pay nothing on them. If you go into higher rate, then you pay 25% on the amount that it goes above the basic rate band. So if you pay £10,000 above your basic rate band, the present tax price of that to the individual is £2,500. Now, company is a good way of retaining profits, and by keeping the money within the company, you can control the amount of tax that you pay. So you don't have to pay higher rate dividend tax unless you actually take dividends out. But you need to be aware where the limit breaks, how much you've already had. Because if you just take money out, take money out, take money out, and the accountant comes at the end of the year and kind of retrospectively puts dividends in, you could be well in excess of the basic rate band. So instead of retaining profits, you're just taking them out. Now, basically, any money that is retained in the company can be looked upon as rainy day money. You can take it out at a later date when it's more tax advantageous to take it out. So limited companies become a great way of controlling the level of profits and the level of tax that you've got. I kind of put an analogy that it's like having a tap on your level of profits. You can turn it on, pour it out to the amount that you want, up to the limit of your basic rate band, for example, and then turn it off. And you only turn it back on if you are willing to take the additional tax liability. But at least it's you that's making the decision. And in this regard, what you're doing is not deciding whether you pay now or whether you pay later, but at least you're in control. Now, once you've taken out the 4 items that we've mentioned before, salary, dividend, basic rate, director's loan account, and higher rate dividends, the last resort is additional salary. And usually you've got to do this because you just can't take dividends. You haven't got the profits, perhaps making losses, or there's other reasons why you can't take out profits in the form of dividends because of diverse shareholdings. And so you've got no choice but to take it out as salary. And often it's not a question of choice. You've got to take it out in salary because you've got no profits, and you've got to take it out because it's the only way that you can get money out on which to live. Now, the reason why it's not such a great idea to take salary above the minimum level that I mentioned earlier is because you pay 20% tax on it, or possibly even 40%. You pay employees national insurance of 12%, and you pay employers national insurance of 13.8%. So that gives you a cut of 45.8%. You do get a degree of tax relief under corporation tax, but you see a significant amount of tax. Hence the reason it's the last resort. So to summarise the current strategy, you take out a minimum salary, you take out basic rate dividends, and you've got to be aware of how much you can take out in basic rate dividends. Exhaust your director's loan account once you've got beyond the basic rate dividends. Then take out higher rate dividends, but only if you want to and if you're prepared to accept the tax charge. And if you can't do any of those, then you take out additional salary. Now, I did mention that everyone is different and everybody will fall within one of those, that strategy, and it will vary depending upon what income they've got, what benefiting kinds they've got. All these bite into your basic rate band and make it reduce the amount that's available to take out as dividends at a lower rate. Obviously, you need to talk to us, or you need to talk to your existing accountants in order to find out what capability you have got in terms of taking out dividends to the best advantage. And it's very much at this moment in time making the most of what is available to you in order to get the dividends out between now and the 5th of April at a lower tax cost than it will cost you after the 5th of April. So it's a case of acting fast while stocks last, and you've literally got until the 5th of April to get dividends out within the basic rate band if you can. And my advice to all of you is that if you've got the capability of taking dividends out between now and the 5th of April, then do so, because you'll be wasting an opportunity which won't come again. Because we all know, and hence the reason why we're all on this seminar, coming soon is the dividend tax. Now, the bottom line on this is all of us is going to be paying more tax. Despite that, the fact that I'm going to give you some ideas of how you can chip away at the amount of tax that you have to pay, it's inevitable that you are going to pay more tax. The government anticipate that they're going to collect £2 billion by additional tax. And 2 billion, you know, when they quote budgets and things like this, is a bit of a drop in the ocean. But it's not when it's divided by the number of business owners that are going to have to pay it. Everybody's going to be paying substantially more tax than they have done in the past. And that is inevitable as a result of dividend tax. The question is, how much extra tax? Now, we've mentioned that we've got a personal allowance of 10,600. The basic rate limit is 31,785, and the high rate threshold obviously is 42,385. Now the primary threshold for taking out a salary is 8,060. So if you take that out, then the amount that you can take out in dividends is 34,325. And what I've done is try to work out how much that will cost you this year compared to how much it will cost if you take that same sum out next year, to give you an indication of how much the cost will be. 2016-17, if you try to take that amount out, less the tax credit, 3432, the actual dividend is 30,893. So how much does it cost you to get a dividend out of 3893? Well, you've got the balance of your personal allowance of 2740. If you've taken a salary of, if you've got a personal allowance of 11,000 and you've taken out a salary of 8,060, you've got a bit left over. The taxable dividend is going to be 28,153, and that's going to be taxed at 0% this year. Sorry, we're talking about next year. Next year you've got 5,000, which is taxed at nil rate. So you won't pay tax on the first 5,000 of your dividend, but you will pay tax at 7.5% on the balance, which is 23,153. Remember, this is somebody trying to take out the same amount as they can take out this year without paying any additional tax. So the tax that they'll pay on that is going to be £1,730 extra. So in order to pay a dividend of that amount, you've got to have profits of 38,616, lose registration tax of 20%, so you've already paid by that time 7,723, so that you're free to make the dividend of 30,893. We've already mentioned the personal liability on that is 1,736, and the total tax is going to be 9,459, and the tax percentage is going to be 24.5%. Now, bear in mind what's just happened on that screen. At the moment, you used to just get in a corporation tax bill on the profits that you made before you pay it out for dividends. And personally, unless you've got other income, you don't pay any additional tax. From the 5th of April onwards, you will also get a personal tax bill, which will come at you. The first one will be the 31st of January 2018. And your total average tax rate will increase up to 24.5%. Now, if you move it on to 2021, it softens a bit because the corporation tax for that year was going to be 18%, which is 6,781. In this budget, they have announced that it's going to be 17%. So you'll be getting less tax there. But even at the tax rate of 18% plus the personal tax, you can see when it gets to 2021, the percentage tax rate is lower. It's 22.6. So basically, the dividend tax makes it go worse. But then, as the corporation tax rates come down, and the personal allowance and the basic rate band go up, then it will soften. It won't be as hard in later years as it will be next year after the 5th of April. So if I look at now, if you take money out within your basic rate band, it just costs you the 20% corporation tax. Next year, it's going to cost 24.5%. And eventually, it's going to be 22.6, but it will be less than that figure because the corporation tax rate is going to come down to 17%. And that hasn't been included in these slides. I haven't adjusted them for what's happening in the budget because I wanted to try and give you an indication of the impact that this budget will have, that the budget that's just gone by will have. One of the things that's happening with the new rates is the abolition of this absolute nonsense of the tax credit on a dividend. Needless to say, I've got these slides out of order. You can see that you're going to get more tax now under the new regime than you've been in the past. Okay, But let's talk about this dividend abolition of the tax credit. At the moment, if you declared a dividend of £9,000, that is deemed to have a tax credit of £1,000. So it bites a hole in your basic rate band to the tune of £10,000. If this is over and above your basic rate band, then you've got the ridiculous thing that everybody finds it so difficult to understand, that you've got a dividend tax rate of 32.5%, but you get tax relief for the tax credit that you've paid of £1,000. So if you take that away from the £3,250, you get a tax bill on the original £9,000 of £2,250. Now, we've always said to clients, forget all this notional tax credit and 32.5%. If you take a higher rate tax dividend, then it's going to be 25% of the actual dividend that you've taken. But the crucial thing in this regime with you've got the tax credits is that it adds a fictitious amount for the tax credit to the actual dividend, and more of your basic rate band has gone. Well, that is going to be abolished. What will happen now is whatever dividend you take out, there'll be no grossing up. If you take 9,000 dividend, it will be take 9,000 out of your basic rate band, and this will mean that there will be more available within the basic rate band that you can take out, and it makes it so much more easier to understand. So in one sense, that's a plus, if you can look upon anything relating to the dividend tax as a plus. So basically, you're taxed on what you declare, rather than the figure which is adding a calculated figure for the tax credit. That's going to make it a lot simpler to understand. So let's have a look at what the dividend tax rates are. The first 5,000 is at 0%, and that gives us one of the planning opportunities to maximise that. I'll come up later. If it's a basic rate, falls within your basic rate band, which will go up to 43,000, your personal allowance plus your basic rate band, you will pay 7.5%. And if you are a high rate taxpayer, you'll be paying 32.5%. Remember what I've just said, at this moment in time, a high rate taxpayer taking dividends out above the basic rate band will only pay 25%. If you happen to be an additional rate taxpayer above 150,000, then it's 38.1%. Now, if we compare the new and the old rates, well, the old rates, you paid nothing on anything within the basic rate band. But then when you got to higher rate, you paid 20%, and additional rate 30.6%. Now, you don't have to be a mathematical genius to see that all the rates have just been hiked up by this 7.5%. So whichever band that you fall in, except the first £5,000, you will be paying 7.5% more next year than you are this year. To give another indication of how it will cost, if you kind of do it on a marginal basis, assume you've got a company with £100, you lose £20 in corporation tax, so available for dividend is 80, and you take that dividend out. Well, the dividend tax, once you've got above the first 5,000, will cost you £6. So the total tax is the corporation tax plus the dividend tax, £26. Out of £100, that gives you a marginal tax rate of 26% if you are a basic rate taxpayer. If you are a higher rate taxpayer, then obviously you're going to be paying more. You're going to be paying 32.5% on your dividends, which is £26, giving you a total tax bill of 46%. And if you're an additional rate taxpayer, then you're going to be paying 50%. Now, it's easy to see that the new rates are significantly higher by 7.5% than the old rates. And it's inevitable that the Inland Revenue are going to collect more tax of all of us because of this dividend tax. And as I mentioned before, they're expected to raised the fantastic sum of £2 billion. That's 2 million million. An awful lot of money. Needless to say, the first bit of advice that I've already alluded to it earlier on, you must take as much as you possibly can in 2015-16 so that you're paying it at these old rates rather than new rates. So you need to be aware of how much dividend you've taken out already, how much other income you've got, and work out how much spare you've got in 15-16. If the company's got retained profits or you're currently making enough profits to cover the dividends, maximise the amount of dividends that you can take out now. It's a one-off opportunity to do that. Okay. Now, I mentioned how you make a dividend legal. If you're accelerating dividends, in other words, taking more out this year, instead of taking less out next year, you've got to make sure that you do them right. Do the documentation, make sure they're paid, so it anchors the dividend in this tax year rather than next tax year. Because given the scope for the Inland Revenue to challenge it, then they could say it's a dividend declared in next year and therefore we should have the additional tax on it. Of course, it's not much point accelerating dividends to you this year to avoid 7.5% next year if it's going to take you above one of the tax thresholds so that you end up paying more tax anyway. So you've got to make sure you don't cross the thresholds unless you've got a very good reason for doing so. So what are these thresholds? Well, the first one is the where the high rate band kicks in, which is at 42,485. What's happened to the slides? Marie, I have a problem with the slides.
Is that what's the problem, David?
On my screen, the slides are not moving.
Oh, yeah, they are moving on this screen. So, yeah, I think I think they're
operating a bit blind here.
Okay, which what do you expect on the screen?
I've got let me pan back to where it was. Right. Okay, the high rate kicks in at 42,385, and I've lost them again. I've got them back now. The child benefit, if anybody's claiming child tax credits, then if you go above £50,000, then they start clawing them back, and when you get to £60,000, they claw them back completely. So it doesn't make sense to increase your dividends and push yourself into the tax band, the income between £50,000 and £60,000, because you'll be losing more in child tax credits than you're hoping to gain. The next tax band is where you get to the point where they start taking away your personal allowances, which is 100,000. So it doesn't pay you to increase your dividends and push yourself into that bracket up to around about £121,000, because you will lose more in personal allowance and therefore pay more tax than the 7.5% that you're paying, or what you're trying to avoid. And of course, it doesn't pay you usually to go up into the additional rate band, because then you're going to be paying tax at a higher rate and again, you won't be saving a great deal. You'll be paying more in tax. It does, however, pay you to take more income in 2015-16 and then take less in 2016-17, and you can perhaps manipulate your income in order to do that. You can do it to affect your child tax credits. So imagine you've got somebody with, say you've got £60,000 income this year. sorry, 50,000 this year, and going to be 60 next. Or I'll say better example. Let's say it's 60,000 in both years, so you wouldn't get child tax credits. So by bringing forward 10,000 into this year to make it 70 this year and taking out 50 next year, it would mean you wouldn't get tax credits this year, but you wouldn't have got it anyway. But next year you're down to 50,000, so you won't get any clawback of your child tax credit. So what you could do is you could yo-yo in and out of getting tax credits. One year you wouldn't be eligible, the next year you would. So by taking 70, 50, 70, 50, it's better than taking 60, 60, 60, 60. And the additional amount, if you pushed it into this year, would pay less in tax than it would do in next year. So it's worthwhile considering something like that if you are getting child tax credit. The question is, should you cross the threshold? And it depends upon your future intentions, what the income is going to be in next year. It might be better to take more this year and pay instead of taking it next year. Now, if you're higher rate this year and you're going to be higher rate next year, then by taking the dividends this year, you're going to be paying 7.5% less. So you will save 7.5% by pulling some of the dividends out of next year and sticking it into this year. The only fallback on that, though, is that by bringing them into this year, you'll pay the tax a year earlier. If you've got the money sitting in a bank account earning 1-2%, you're going to save 7.5%. So it's worthwhile doing that as long as you're going to be higher rate this year and higher rate next year. I've already mentioned the situation whereby you can manipulate the income figure for going into high rate tax. It's a no. If you're already above 60,000, it doesn't make any issue. But certainly don't raise your income so it takes you above the £50,000 and in between 50 and 60. But you can kind of use it to try and make 1 year fall below £50,000 if you plan your dividends carefully. It doesn't pay you at all to go above £100,000 by taking additional dividends this year, pushing your income above £100,000, because the additional tax that you'll pay just wouldn't be worthwhile. But where your taxable income is above 121,200, you'll lose personal allowances anyway, and therefore you get the same effect. If you accelerate some dividends into this year, you get 7.5% less tax payable because there's no dividend tax this year, but you will pay the tax a year earlier. Because of the implementation of the new dividend tax, it involves having a change of strategy once we move in to next year. Remember, this year's strategy is take as much out as basic rate dividends as you can take out. But now we're moving into next year, and we're going to have a new strategy, so we need to change. The salary, well, the national insurance thresholds haven't changed, so only take up to the national insurance threshold of 8,060. However, this year it does pay you, if you've got more than one company, to take more than one salary. Now, in the past, we've only said you need to take it out in one company. No point in taking it out in another company, because then you'll get a personal tax liability of 20%, and you could have got it out in dividend without that liability. But now, if you've got more than one salary, say you've got two, so you've got 16,000 roughly. The first 11 is covered by your personal allowance. You'll only pay 20% tax on 5,000, which is £1,000, but the company will get full tax relief on all that salary, on both the salaries that you're putting through. So all you're doing is switching a lesser amount of personal tax and reducing the amount of the corporation tax by a greater amount. You've got to remember, though, once you receive the money, you're going to get the tax bill. So you've got to put the tax away and save it. But by having additional salaries, you can get money out with save tax on actually doing it, and you avoid paying the 7.5%. So it pays you to have more than one salary if you've got more than one company, as long as you're only paying the marginal tax rate of 20%. Only pays you to do that if the company's paying 20% and you're paying 20%. Doesn't pay if you're taking it out and you're making use of a higher rate. You've got the personal a balance of the personal allowance available, and if you don't take additional salary, you can use that against dividends, which I'll be coming to shortly. There's also the possibility to pay other family members, like your wife, your spouse, your civil partner, or other family members. The only proviso on this is the amount that you pay them must be justified in terms of the amount of work that they've done, because otherwise the Inland Revenue will deny the tax relief for the company and won't get you tax relief on it. Or worse still, they could actually say that's really income that for you and add it to your income that you're taking out and get the 45.8%. But look for opportunities to pay to other spouses as long as it's justifiable. And also make sure that you're only going to get a marginal tax rate of 20% to match the corporation tax relief. One idea that I came up with was deliberately fragmenting your business to create more than one business, so you had more than one company. I must admit my client managers weren't too impressed with this idea, but since we've started doing this seminar, it's started to have a little bit more legs behind it. But the basic idea is this: is you set up a new company and you pay additional you generate enough income in there to pay additional salaries. Now basically what you'll be therefore getting is another batch of £8,000, and if there's husband and wife situation, then you'll get 60,000 extra salary out by taking a salary from the second company. That will save you at assuming that this 16,000 would have been taken out as a dividend if it was just through one company, you then save 7.5%. So you're saving £1,200. If you're a high rate taxpayer, you actually save more, you save £2,000. Now, if you're just setting up a company purely to do this, would it be worthwhile? And I speculated that for a company doing this, we could do a reduced accountancy cost of say £800 to cover this. And my client managers felt, well, it wasn't really worth doing it just to save £400 for the basic rate taxpayer. It does become worthwhile doing this if you've got another reason for having a limited company. And in this day and age, setting up a lifeboat company where you transfer the trade name, you actually sell the trading name to the lifeboat company, and you sell all the key equipment that you've got, the vans, the plant and machinery, all the stuff that is essential for you doing your business. You sell those to the company and then just lease them back to generate the income. Well, if the company ever went into liquidation, a principal company, then you wouldn't have to go to a liquidator to try and negotiate with them for the trade name and the key assets. You could just jump over to the lifeboat and start trading through that because you own the trade name and you've got the key assets. So since mentioning this, I've had a number of clients coming up to me saying, I like the idea of a lifeboat, can you create one? And it's cost them nothing, because even if it costs them, the tax saving just covers the accountancy costs, they have got their lifeboat company for free. And so from a speculative idea, this has actually created an instance where clients have come on and said, yeah, I fancy having an additional company because I operate in an environment where there's lots of risk. The Inland Revenue are just taking liberties left, right and centre, coming up with all these penalties and fines, and I'd rather be able to avoid it if it really got nasty. So there's possibility of fragmenting your companies in order to do that. And there's also the fact that my belief is that 7.5% is just the starting rate for dividend tax. I think as time goes by, it will go up. All the other tax rates are capped. In other words, they will not increase them during the life of this Parliament. But the dividend tax of 7.5% isn't. And once it starts to grow to 10%, 12.5%, whatever it is it grows to, then the differential of the tax saving of having additional companies becomes more and more viable. So, number 2 strategy, you've already taken out your salary, won't change compared with this year. The only thing that will change is that there's an incentive to take more salaries out. You've got a balance of your personal allowance left over, which means therefore that, and you've also got the nil rate band. The first 5,000 of your dividends is taxed at nil. So 5,000 plus the extra bit of your personal allowances means that you can get out, in addition to 8,000 roughly in salary, 8,000 in dividends. Now, if you've got 2 companies, you can, and it's husband and wife situation, then you can take 2 salaries out, so that's 16 plus 16, 32, and you can take out dividends of 8 each. Sorry, no, you would only be able to take dividends of 5 each because you would already used up the balance of your personal allowance. But that's 10 between the 2 of you. So between the 2 of you, you can get £42,000 out if you've got 2 companies without incurring any of the dividend tax. It's only once you go above that you'll actually get the dividend tax. Now, even if you don't have the additional company, you can get 16,000 out each. If it's husband and wife, or if it's just a sole director, at 16,000 for themselves, without incurring any additional tax liability. And as a number 2 strategy, you must at least do that. Take your minimum salary, take 8,000 in dividends, because you get that for nothing. So again, if you don't take it out, it's like the old present situation. If you don't use it, you lose it. You must take out dividend of at least 8,000 a year to use up the amount that you can get out of the company completely free. If you are a director and you haven't got your spouse in the company or civil partner, then it does pay you to kind of split the shareholding between the 2 of you so that they can both use the nil rate allowance, both get £5,000, so you can get £10,000 dividends out of the company without paying any tax. And in the past, if you've got someone that's been using up their basic rate band, say they're a higher rate wife or husband is a higher rate taxpayer, there was no incentive whatsoever to make them a shareholder because they would have to pay tax on the dividend. But now 5,000, so even making them a minority shareholder so that can get £5,000 in dividends, gets 5,000 out of the company without any additional tax charge. And it's worth considering. And you can also change the shares into alphabet shares, A's and B's, to be able to get differential dividends out and avoid having to do waivers. You can also give shares to adult children. The kind of idea behind this is they're going to university, you're going to have to be paying them 5,000 to 6,000 for accommodation and fees and stuff. Might as well make them a minority shareholder in a company. I've had people who've been on the seminar coming up to me and saying, oh, can we do it to grandchildren? And at that point I start saying, you don't want to be passing shares out to grandchildren who you don't know who they're going to get married to, you don't know what they're going to do. You might have a little bit more control over your children, so you can risk it with your own children, but risking it for anybody else, not a wise thing to do. Minority shareholdings can become very, very valuable, and they can be very troublesome. So be very wary about just giving it away for a small tax advantage. But there is scope there if you've got children who are definitely going to go away to university, and you're definitely going to have to be responsible for them for 5 or 6 years or so. So there's an opportunity there as well. needless to say, you've only got one amount of £5,000 to cover all dividends. If you've got a portfolio of dividends coming from other shares, and most people have them from banks, building societies that have incorporated, pension schemes which have done the same, then it pays you to consider, subject to legal financial advice, got to see the IFA to see if it's a good idea from a financial basis, to cash in those shares and transfer them into an ISA wrapper. And they've made the ISAs far more generous in terms of the amounts in this last budget that you can put in there. But basically the idea is to kind of make sure that they're not biting into this first £5,000 and leave room for the dividends that you can take out of the company to be at the nil rate. Now this is where we start going into doing things a little bit different to what we've been doing before, and I put this slide up thinking that everybody would recognise that, but a lot of people on the seminar, it just went straight over their heads. So I think you've got to be of a certain age. But now for something different, new strategies. If you've got money on your director's loan account, I've already mentioned it's a good way to withdraw that to be able to get money out of a company without incurring this dividend tax. So exhaust your director's loan account first. But we've got some clients with absolutely massive director's loan accounts and no intention of withdrawing them. In fact, they might be needed as an essential part of the finance of the company. But you can pay interest on a director's loan account. And that interest, if it falls within the new personal savings allowance of £1,000 for the basic rate taxpayer, £500 for the higher rate taxpayer, is tax-free. So by getting £1,000 out of interest on your loan account, you can get that and pay no tax on it whatsoever. Yet the company will get 20% tax relief on it. So again, it's going to save you 200 quid by doing that, and it's £200 well worth having. There's a bit of a cliff edge if you move into higher rate as a result of this, because it reduces your allowance down to £500, which seems a little bit unfair, but nothing fair about taxation. Number 4 is obviously pay money back out as loans from the company. Get it if the company does owe you money, rather than taking it out as interest, actually repay the loans. And this becomes very useful if you've sold some assets into the company. We've got a property company, myself and my wife, and we've transferred properties in there, and as a result the property company owes us the money for the property. And so we can shield the amount of money that we take out in dividends. Instead of taking it out as dividends, we can repay the director's loan as long as it lasts and get it out. Now, if you've got some assets which are used by the company, then you can actually sell those to the company. Could be equipment, could be property, and create a loan account which gives you the ability to kind of top up the basic rate money that you can get out of the company and avoid paying higher rates of tax. I did speculate about the idea of overdrawing the director's loan account. I mentioned earlier that you shouldn't do it because what you get is Section 455 tax, which at 25%, you get that back if you repay the loan. But I kind of speculated that wouldn't it be worth getting Section 455 tax out at 25%? Because if you are a high rate taxpayer, you'll be paying 32.5%, and it's cheaper. Well, the government have realised that that was possible, and in the latest budget they have increased Section 455 tax from 25% up to 32.5%. So this idea that I had, which I've left in the slides, is no longer possible because the Inland Revenue have blocked it. I also kind of speculated that if you overdraw in 1 year, you incur the Section 455 tax, then you pay it back at a year where you can get a lower rate dividend out. If you've got variable income, then you can kind of manipulate whether or not you're paying higher rate or lower rate dividends, and you could then pay back the Section 455 tax. Again, possibility in doing that, but it's got to come with a risk warning. Anything whereby you overdraw your director's loan account, you are effectively giving away your limited liability status. If you owe your company £100,000 and you go bust, then the liquidator will come after you for that £100,000. So it means you can't walk away from your company where you can if you don't have these loans. So it's dangerous having these directors' loan accounts in an overdrawn state, despite the fact that you can perhaps manipulate the amount of income tax that you can pay just by doing that. You will lose a limited liability if you've got these loans, and therefore probably not worth doing. You also have to do a Form P11D if the amount is above £10,000, which adds to the admin burden of everything that you've got to do. I did have a speculative idea of overdrawing your director's loan account and liquidating the company and getting the liquidation cost of about £3,000, but again, I thought you would lose the Section 455 tax, but I've been informed by an insolvency practitioner, no, you wouldn't. You would be able to recover it. Again, the Inner Revenue have kind of cottoned on to that idea that coming close to retirement, people will be avoiding paying dividends to avoid paying the dividend tax, and then taking the money out in a capital form in order to try and get entrepreneurs relief. And they're denying entrepreneurs relief. New provisions have come in. If they think that they are effectively is the means of, it's not a genuine retirement, what they're doing is trying to take out profits by shutting down this company and starting up another one, and then taking it out as a capital distribution rather than an income one. So they have brought measures in to kind of counteract that. Again, I left the old slides in to kind of give you an indication of how the new budget, they've kind of realised some of the things that they've got to tighten up on. The next idea is pay rent. Now, those of you who are existing clients know DEB House. This is owned by me and Janice personally, and we were a bit concerned that if we were to die, we would end up paying 40% inheritance tax on the value of this property. We were about to transfer it into a holding company and then hive up the accounting practice so that the property was in the same trading entity as the actual trading activity, and therefore will get business property relief. And that is still something that is worthwhile doing when you're getting close to the point of time where you think you're going to put your clubs. But when they brought in the dividend tax, we immediately about turned. Our accountancy practice is paying us rent. So we can get the rent out, the company gets tax relief on the rent, we pay basic rate tax on the rent if we maintain ourselves within basic rate band. So we don't pay any additional tax, but we get the money out of the company, and we don't pay the higher rates dividend tax on it. So we've immediately abandoned this idea of transferring the company into the property into the company, because it gives us an extra way of getting money out without incurring the dividend tax. We can avoid taking dividends and take rent instead. And again, it's got to be a case where the company is paying the same marginal tax rate as the individual. So basically, we're looking at a basic rate situation here. The company gets 20% tax relief. The tax liability switches over to the individual. So out of the rent, you've got to 70%, but you probably would have been doing anyway. A risk warning comes along this. If you start charging rent for the company, then that will affect your entrepreneur's relief when you come to sell it, because you are converting it from a business asset into an investment asset. So you won't get the 10% entrepreneur's relief on selling it, which you would do if you sold it along with the business at some future date. But the view is tax now is better saved than tax in the future. If you are getting the money out, saving 7.5% on the rent each year, it may be worth considering giving up the entrepreneur's relief, which by the time you get to the point where they sell it, they might have abolished entrepreneur's relief anyway, because they mess about with capital gains tax every time there's a change in government usually. So it might not even be there by the time that you get to the point where you sell the property. It also has an impact upon business property relief. If you die, and you may render the property as a non-business asset and not ranking for inheritance tax, and therefore you may pay 40% on it. It's one of these things where you've got to weigh up the pros and cons on this to find out which is the best one for your advantage. Now, pensions. Pensions have got a new lease of life as a result of the recent changes. Pensions over the last 10 years or so have not been great things because you could get 25% of your pot out as a tax-free lump sum, but the problem was that the 75% that was left in had to be taken out as an annuity. And annuity rates, because of people living longer and interest rates down at the rock bottom, were absolutely appalling. Excuse me, need a drink. So, trying to persuade a client to put money into a pension, their argument was, what's the point? Okay, we get relief on it in the company, but once it goes in there, it's in such a poor investment, it's worth having. Well, that's changed. Now you can put money into a pension, and when you get to the age of 55, you can take out tax-free lump sum, and the rest you can take out how you like. So you can take it out and pay tax on it as a kind of a planning tool going forward, or you could just leave it till you die to provide a kind of a fund for inheritance tax, because it falls outside of your estate and it goes wherever you put the expression of wish to your trustees, so presumably to your children. So it becomes a far more effective planning tool. So in terms of actually getting money out of the company, especially if you've got big amounts of cash building up, sticking some into a pension would be a good idea. However, I speculated back here that this may disappear, because at the time I was writing these notes, there was big talk about pensions being stopped as a means of tax deductibility in the company, and they would become more like ISAs. You don't get tax relief on going in, but you get the money coming out. And there's been significant changes in the ISA regime, lifetime ISAs for the people under 40, where they can put money in for either saving up for the first time buy, if they're saving up for a property, or effectively saving up for retirement. And they've backed off from making pensions, taking away the tax relief on pensions. I think it's temporary. I think they will still try to do this in perhaps a later budget, but for the time being, they survived this one. I think they got a lot of pressure from people in industry, and they've not cancelled pensions. So it still remains as an option, and you can put £40,000 in this year, and you can utilise 40,000 that you've not done for the last couple of years. So you can get about 120,000 in there, and if you're approaching the age of 55 or over, you can stick a big sum in there, take a 25% tax-free lump sum out of it, and then leave the rest of it 75% and decide later how you're going to get it out, but you're no longer compelled to buy an annuity. So it becomes a very, very powerful planning tool as a pension scheme, more powerful than it's been in the past. Now, I put a blog out this last week on transfer of your personal allowance. You can transfer 1/10 of your personal allowance, and you can do it for this year as well. I'm speculating about it in next year. You can transfer 1/10 of your personal allowance, which is £1,100, to your spouse or civil partner. Why would you want to do that? Well, imagine you're paying dividend tax on your basic rate dividend. If you gave away £1,100, that would cost you 7.5% of that. You'd pay 82.5% more tax. If you give it to your spouse who's in an employed situation paying 20%, whilst you pay 7.5%, they would save 20%. So they would basically, between the two of you, would save 12.5%. So you'd be better off by £137.50. Now, you can apply to do this online. Obviously, once you've given away your personal allowance, then your other half gets the benefit of it. But there's a bit of a saving to do that there. And as they say, every little helps, I suppose. Now, the bottom line, despite the things that I've just mentioned where you can just chip away, the 3 or 4 strategies, is that you will pay more tax. You will need more dividends out than you can get out at nil rate to live off. Therefore, you will be getting more personal tax payable at the 7.5%. And my belief is that this is the thin end of the wedge. When they introduced it, they said these changes will also start to reduce the incentive to incorporate and remunerate through dividends, rather than through wages to reduce tax liabilities. They are wanting to take away the difference between taking money out of dividends than through PAYE. So I think that this is going to increase. Now, one good thing is they've said that they're going to increase the thresholds. I'm just trying to get back to that slide. No, it's not having it. Right, we're not going to do that slide. They have already announced that by 2021 that the basic rate band will go up and also the personal allowance will go up. So that will mitigate the amount that you can get out tax-free and also the amount that you can get out at 7.5%. Whereas that this year we're trying to minimise the amount of money that you can get out at nil rate, next year the whole argument is how can you get it out and only incur 7.5% instead of 32.5%. And in that regard, strategies will not change. You will still be trying to minimise the amount of tax that you pay, but by paying less. But at least the tax rates will go up over time. The one thing you do have to bear in mind, though, is that you are going to get a personal tax liability. And as a result of that, you are going to have to watch out for payments on account. Up till now, clients of DEB have always been in the position whereby they've got a corporation tax bill, but rarely a personal tax bill. But now they are going to have a personal tax bill. And the way that it works is for 2016-17, if you've got additional tax, let's say 1,200. Now remember I was saying that someone utilising the basic rate band is going to be paying about 1,700, 1,800. If you've got a personal liability of 1,200, say, then you've got £600 payment on account for the following tax year. So that means that you, on the 31st of January 2018, which is the first date this will bite, you will have a tax bill of 1,800, followed by another tax liability of £600, the second instalment, the following 31st of January. Needless to say, you've got now, as you take dividends out of the company, where you fall into a taxable position, you've got to start saving. You've got to put money away because you're going to get personal tax bills. And if you fund those out of more dividends coming out, you're going to be kind of creating a situation where it just keeps winding up where you're paying more and more tax. So when you take dividends out, you've got to prepare for this additional personal tax liability. Also, if you've got spouses who have hitherto not been subject to self-assessment because they have been taking dividends within the basic rate band, they're now going to have to be in self-assessment so that they can declare these dividends and pay over the tax on them. So there's going to be more people going into self-assessment. So the conclusions that we make from all this lot, we're all going to be paying more tax. We all need to save because we're going to get personal tax bills, which we're not used to. We haven't been used to them for quite a while. You're definitely going to get personal tax bills come the 31st of January 2018. It pays you to be aware. You need to know where you are, what dividends you've taken, what director's loan account you've got. You've got to know what the rules are so that you can maximise the amount that you can get out, either at nil tax rate or at the lower rate of 7.5% instead of 32.5%. And in that regard, you need to plan ahead to make sure that you take out the optimum amount of remuneration and dividends based upon your income profile. Obviously, we can help. Just contact us and speak to us. We can help you talk your way through what the changes are going to be. The whole purpose of this webinar and the seminars to raise your level of understanding so that when you start talking to your client managers, then you'll have a better understanding of what they are talking to you about. And each of you do need to have a word with your client manager to kind of understand where you are. We'll continue to provide with the help, information and advice. If you're not on our mailing list, make sure that you are, and we will supply a lot of information through the excellent mailing system that Murray has provided us with. And the idea is to keep providing you with more information so that you're as well informed as you need to be. Of course, we'll help you formulate your strategy, but we've always done that. It's going to be no different. It's just going to be far more important because whatever strategy you're going to have now, you're going to have a bigger price tag attached to it in terms of your tax. And as circumstances change, tax rates, your income profile, your wants and desires and whatever it is your need change, then you're going to need to react and your strategy is going to have to change. Your strategy is no longer going to be a kind of, oh, just take a small salary and the rest in dividends. It's going to be very variable depending upon your circumstances. So basically you've got to react to any changes as that. We hope to have more webinars and seminars. As I mentioned about the Business Wise Forum. Keep in touch with us and we will keep keeping you on the mailing list and let you know what these things are. We would like you to attend because we want our clients to be the best informed as we possibly can, because once you're aware of things you can make tax savings. And that's it. Thank you for attending. So if there are any questions, you can either ask them now or you know, we can have an open forum which Murray will kind of sort out now, or alternatively you can give us a ring and speak to us individually. Over to you, Murray.
We've got a few questions coming in already, and I just want to mention that we're keeping all the questions anonymous, so we're not going to say your name because obviously we're dealing with some sensitive issues here, so please feel free to ask away. So the first question that we've got coming in, this goes back to what you were saying about the director's salary, and it says, you mentioned that the director's salary should always be paid. If there are insufficient funds to pay the director's salary, can I make a virtual payment out of the director's loan account?
The answer is yes. But again, we still prefer to pay them. You know, if you say that your salary is, I don't know, £600 for the month. If you've got 600 in savings, you could put that into your director's loan account, then pay it out. So effectively, it just goes round in a circle. It doesn't cost you any more, but at least you do get the payments, and it does. And the same applies with dividends. You know, we've had clients who, when it gets to this time of year, they've been taking out, say, 4,000 a quarter, so they've only had 16,000 out. We say, oh, you need to take 32 out, and there's a couple of directors, they need to take an extra 16 each. That's 32,000, and they haven't got 32,000 in the bank. Well, they've got 10,000 in the bank, so they pay 10,000, put it into the personal account, let it clear, a couple of days later, pay something back into the company, and then the same amount of money goes round in circles 2 or 3 times. Now, it's at the bottom line, it is not essential. But we've always been accountants who have kind of been proactive. We look forward to see what is possible, what might happen. And it's always better, with the benefit of hindsight, to pay these things rather than credit them to director's loan account. But as the person who raised the question, if you haven't got it, then when we come to do the accounts at the end of the year, we would always say, you should have had this salary, you haven't got it, and we will credit it to your director's loan account. It's just one of these things where it's better not to do that if you can avoid it. And
well, let me just ask you this other question, because it's similar, it's related anyway, and it's on a similar subject. It says, this question says, I've made a profit, but I haven't got enough funds to pay out a dividend because I've got a lot of aged accounts receivable. Would it pay me to factor these invoices and pay out a dividend to avoid the tax? It's an interesting question.
No, it wouldn't. Factoring, I'm not a big believer in factoring because it's very, very expensive. And it's no point doing that just to save the 7.5% extra dividend that you've got. You don't have to pay on the ultimate, the dividend. You can vote a dividend and it be credited to your director's loan account. But remember the things I said, that the other things that you can do is record it in your bookkeeping. So if you've got Sage or QuickBooks, you can do the double entry to actually put the transaction through to credit your director's loan account. If you're a client of ours, then the documentation will say if it's not paid within 10 days, it is deemed to be credited to your director's loan account. And we've had one instance, as I mentioned earlier, where this has gone by the Inner Revenue and they've accepted it. Well, they haven't questioned it, they shut up about it. So we're reasonably confident that it will work. So it's again a question of, if you haven't got the funds, because all your profit is tied up in debtors, doesn't stop you from doing a dividend, it just stops you from paying it. If it doesn't pay it, it can get credited to your director's loan account. My only advice in that regardless is try and pay it. If you can't pay it now, pay it as soon as you possibly can. If you've only got a small amount of money, put it in and out, in and out, in and out, in and out until you've paid it. But that's just me kind of putting my personal view on this. The technical view is you can credit your director's loan account with dividends, and it should be as effective.
Okay, so it sounds like paying it out is the best policy, and that documentation is really key to making sure that it's hard for the revenue to challenge it.
Documentation is essential. It always has been. It's just that a lot of accountants just don't do it.
Okay, so here's another question. My business made a loss last year. Do I have to deduct that from my current year profits when calculating a dividend?
Yes. Yes, it's the cumulative sum, prior year profits or losses, plus the current profit minus the 20% corporation tax. That has got to be, there's got to be positive reserves there to be able to pay a dividend out. If you haven't, and it all depends upon the time that you take the dividend, that dividend could be deemed to be illegal. Now, usually the only time that people get an insight of this is what happens in your year-end accounts. But if your company goes bust, and 6 months before you went bust, you took a £20,000 dividend out, and it shows that you didn't have profits because of cumulative losses, then they can come back for that 20,000. The liquidator can come back and demand that you pay it. So you've got to make sure that you've got positive profits cumulatively, rather than you can't just pay them out of current year's profits. Until you've got to make good previous years. And in that circumstance, it may well be you can't take a dividend out, you've got to take out salary.
Okay, thanks for that clarification. Okay, here's another one. It says, you said that a spouse's salary has to be justifiable. Does that mean that she actually has to do some work?
Yeah. The easy way to do that is to create the spouse as a director. I've never ever had director's remuneration challenged by the revenue, and certainly not to the tune of £8,000. If you become a director of the company, you're taking on responsibilities, and those responsibilities and risks have got to be rewarded in some way. So I don't think the revenue would challenge £8,000 being paid to your spouse if they are a director. There are risks associated with being a director, so you've got to take those on board. But if you paid £8,000 to your spouse for doing bookkeeping, the question is, would the revenue accept that? Well, it depends on what the going rate for paying someone to do the bookkeeping and how much bookkeeping is. But if it's only small and trivial, they could say, well, you wouldn't pay anybody else more than £2,000 for doing that. Therefore, £6,000 is not a tax-deductible expense, and they would deny you tax relief on it. So the answer to your question is, yes, it just has to be justifiable. It's just that it's easier to justify it if they're a director.
Okay, thanks for that, David. And don't forget, if you want to ask questions, you've got the question and answer box here below. If you type your question in there, we'll be able to see it. So we've got another one here, which says, if you retire with less than 35 years NIC contributions, does that mean you get no pension at all from the state?
No, it's abated. You don't get a full pension, but you will get some. And I did mention that all you've got to do is to fill in a BR19. You can get just go onto the internet, put BR19 on it, and download the form. Very easy to fill in. Just tells you who you are, where you live, who you're working for, and they will chase your national insurance records up at Longbenton in Newcastle, and they will give you a forecast of where you will be. And if you've got some deficit, you can always pay the Class 3, 670 odd pounds for a year to make good your deficit. But again, you need financial advice in order to do that, because if you say, oh, you're short, so by paying £2,100 you could fill that in. The question is it a good thing to do? Now, you don't know. You need to know how long you're going to live and receive pension, which is obviously an unknown. And you need financial advice in order to make that decision. So they say.
Okay, yeah, I mean that makes a lot of sense. It's not sounds like it's not straightforward to work that out.
Salary, you can do that for nothing. It doesn't cost you anything.
Okay. Right, we've got one more question here. It says, how much interest can I charge on my director's loan account? How much interest can I charge on my DLA?
Good question. Lending to your company is a high risk situation, and certainly the banks are going to charge you, 7, 8, 9% plus the lending charges. I would think that you wouldn't have any trouble with 15%. I've heard 25%. I've had some clients wanting to put an absolute enormous amount through, but it's all a question of being reasonable. Certainly 15%, no problem. And you've got £1,000 to go at if you're a basic rate taxpayer. So, it's well worth doing it. But you've got an extra layer of admin. You've got to fill in a CT61, which is a form which reports the interest. You can only pay the interest to an individual net. So if you're paying £100, you've got to pay them £80, fill in a CT61 and pay the extra £20 over to the government quarterly.
Okay, thanks for that clarity. It sounds like something else that it would be wise to take advice about.
Well, this is the idea. The idea of the seminars and the webinars is to raise these issues so that you can speak to your client manager and say, what do I do if I want to do this? But you've got £1,000 that you can get out tax-free, and if you've got a large director's loan account which is not moving, then you might as well take some interest out.
Okay, thanks for that. And so we've got another question coming through. Could you recap the two company scenario regarding two salaries and dividends? Right. Could you just quickly go over that again?
At the moment, if you take 8,000 salary, it's covered by your personal allowance. And there's no argument about paying an extra £8,000 because why bother? You could get dividends out without paying any tax. That changes after the 5th of April. If you've exhausted all your amount of dividends that you can take out, the 5,000 plus your 8,000 salary, then any further dividends is going to cost 7.5%. But if you've got another company and you pay £8,000 salary, the company that you pay it out of is going to get corporation tax relief of 20%, £1,600. You're going to pay tax on that because there's going to be £500 over and above your personal house. You'll pay £1,000. So the company saves £1,600. You only have to pay £1,000. But you also avoid paying the 7.5% that you would pay if you were taking it out as dividends out of company number one. So it raises the issue that by having two companies and paying two salaries, whereas in the past it's not been of any use, from now on it is. All you've got to do is to kind of come up with some reason which justifies having the additional company. You're going to have additional accounting fees, you're going to have additional bank charges, you've got additional bookkeeping. You've got to have something to make it worthwhile to do that. And the additional tax saving covers basically the accountancy costs that's involved in doing it. And I speculated that some people would be interested in doing it. Our client manager said, why would they bother? But as soon as I mentioned the idea of a lifeboat company, you know, that seemed to have grabbed people's imagination. And I've got several on the go who are actually doing that. They think it's a great idea to have this company, which isn't going to cost them anything. You know, in real terms, the tax saving covers the additional accountancy and bank charges cost. And yet they've got this company running alongside, whereby if anything goes wrong with the original company, and they have got to ditch it for some reason, then everything that's of value that they want is already established in this other company. So it's well worth contemplating. I think it's only worthwhile if you've got another reason for having a second company. But a lot of our clients have got second companies anyway, for one reason or another. And it pays you now to take a salary out of each of them. Well, not now, but after the 5th of April.
Well, yeah, it's very interesting, and it's interesting, really been very interesting to see how the seemingly simple change in the way that taxation works is leading to so many opportunities. So thanks very much for that, David. It's been very interesting and great to hear your insights about how to minimise tax and how many innovative solutions that you've come up with. So for those of you attending, thanks very much for tuning in today. And don't forget, if you've got further questions for David, you can find him on LinkedIn and connect with him there. You can email the office. We're going to put these details up on the screen in a moment. You can email the office at ben@deb-accountants.co.uk, or you can call David on 01226 245 824. And you can also visit the website at www.deb-accountants.co.uk. And as I mentioned, we'll put those up on the screen when we've finished so that you've got a record of them if you want it. So in the meantime, thanks very much for attending today, and thanks once again to David for today's webinar. I hope you've all found it really useful, and more importantly, that you pay less tax as a result of what you've learned today. So thanks very much, and goodbye for now.
Goodbye.